Welcome back, everyone. This is Mike Eklund and Colton Tinkle with Financial Symmetry. Colton is our senior portfolio manager, and today we're going to talk about what happened in the investment markets in 2025. Before we kick it off, first I just want to say that from a disclaimer perspective, this is not specific investment advice regarding your portfolio. If you do have questions on your portfolio, please contact your Financial Symmetry advisor. If you're not a client, it's a great chance to reach out and talk about how we can help you. All right. So moving into looking back
Yep.
to 2025, Colton, kind of walk us the listeners through kind of what happened last year.
Yeah, I mean, it was a kind of an exceptional market, especially in the international markets. So international markets outperformed US. Bonds actually produced a positive return, which was great to see. So delivering another diversification factor there. So overall, a really strong year across equities and fixed income.
Yeah, and I'm looking at the numbers here on the screen. 22% returns for the equity markets. Is that normal, Colton, or is this a very unusual year?
Yeah, I mean, you expect strong returns, but this was definitely above normal. Whenever we build out longer expected returns, it's important to kind of reframe the discussion as far as the starting point and kind of rebuild that expectation. So not 22% every single year, but it's going to come in ebb and flows.
Okay, so it sounds like it's good to see, but if you are a client or an investor, don't expect that every year. Looking at some of the surprises for 2025. Now, the international markets have been in the doghouse for years, but walking through on this slide, kind of what we saw U.S. versus international stocks last year.
Yeah, like I mentioned, international absolutely crushed it, and international small cap value just obliterated it. So that's where those factors of where we tilt the portfolios to actually showed up, which again, it's been a couple years that we haven't seen that. So our clients benefited from that, which is great. But again, we don't know when these are going to show up. So sticking to those allocations is really the only way to capture that return.
Yeah. Yeah, this is amazing. 30 to 40% returns in international markets last year. That looks very good. I'm sure clients are happy to see that in their statements. It reminds me a little bit. I'm old enough, and I'm going to date myself here, but in the 2000s, we saw a similar story where after a very strong run, the U.S. market trailed the international markets for about 10 years as well. So we'll see if that plays out or if 1 year was just the anomaly going forward. But I think one of the concerns for a lot of folks today, a lot of investors, is, okay, the market has done well. We saw the results last year. Like, is this time to get out? Is this time to sell, sit on the sidelines, wait for things to come down? Or what would you say there?
Yeah, so this slide actually runs through whether or not you should be worried about a stock peak or all-time high, and looking back through history, returns across whether or not you invest at a record high or any other level, returns are stable across. So we expect positive returns from stocks, and that's driven by the revenue that the companies produce themselves, and then also the valuations that expand or contract. So there's a lot of moving parts within that, but like I said, there's not a big difference between whether you invest at a all-time high point or not.
No, that's great. Yeah, for those listening just to the podcast, we have a slide up that pretty much shows, as Colton mentioned, returns at all-time highs versus any other month are pretty similar. So I think it's another way of saying we don't believe in market timing, and we don't think you should either as well. Obviously, it's beginning of the year, so you get a bunch of forecasters. We love to hear what they have to say. So let's go back 12 months, and what were the forecasters saying at the beginning of 2025, and what actually occurred?
Yeah, so thinking about what you saw coming into 2025, so 2024 and before, it was all about U.S. large growth. So that U.S. exceptionalism really showed up, and that was one of the common outlooks that the forecasters put out, was that the U.S. market's going to continue to outperform. So what you actually see is that the finally international outperforming the U.S. market. Same thing in the strength of the U.S. dollar. So a continued strong U.S. dollar was projected for 2025. And what you see now, I mean, the last few days, the U.S. dollars can continue to depreciate. So again, saw that be the complete opposite to what the forecasters actually saw or predicted. So it's kind of avoiding those headlines to make investment decisions, I think, is the main point behind these slides.
Yeah. Tune out the noise, someone might say, but yes, don't follow your investment plan based on what the forecasters say in the media. We did see some turbulence last year in 2025. One of the big things was in the spring with the tariff tantrum. Liberation Day, what the slide we're looking at now kind of shows what would have happened if you tried to time the market. Can you talk a little bit, Colton, about the plan to get out and get in based upon some of the headlines during that month?
Yeah, and again, this is where it makes it really tough. If you're just investing off of headlines, is making those two correct decisions. It's not only deciding when you're getting out, it's when you're getting back in. And most of the time, that volatility is going to be there no matter what. It might be a different headline, but it's going to be there, and that's why you're actually paid that premium for investing in equities.
Yeah. So I always like to joke, if I had a crystal ball, I wouldn't have to work, but unfortunately I don't. So once again, we remind everyone to stick to their investment plan. It wouldn't be an update without a conversation. One of the hot topics today, it was Bitcoin a few years ago. Now it's gold. Gold is the hot topic. It's been doing very well of late, and people are starting to question, should I add gold back into my portfolio? It has not been a popular place to invest for a while. So maybe, Colton, if you could talk a little bit about how gold is compared to stocks and maybe bonds over the longer term.
Yeah. Again, the way that we view portfolios is what role do we want it to play? Gold, as the chart shows here, is returns are lower than U.S. stocks, but volatility is right around the same. So you're giving up that return, but you're getting the same volatility year to year. And a lot of times, we even see it with international markets, people tend to start asking questions after strong performance, which is the wrong way that we look at investing. Again, to capture that return, you would have to be invested prior to that return showing up. So again, just staying allocated based off of what we build out for clients' portfolios based off of their time horizon to needing the cash is kind of the way that we approach.
Got it. Yeah. So in summary, we're not in favor of purchasing gold. It doesn't produce anything. Volatility is like stock market, to return like bonds. So we'd rather own bonds and stocks instead.
Yeah.
Not to forget, obviously we talked a lot about the equity markets, but the fixed income, which is bonds, cash, kind of how do they look today versus what we've seen in the history for your options out there for fixed income?
Yeah, for the last 5 years since basically COVID, rates were extremely low. So any type of rate adjustment to that has a huge effect to the pricing that is actually captured within that fixed income. But now that yields have increased, fixed income is able to regain a little bit of that diversification factor and the role that we want it to play in the portfolio. So again, higher yields support better future returns. So the starting yields look a lot better for future returns in the fixed income market.
That's great. 4 to 5% starting versus 1 to 2% a few years ago. I think people will be happy with that. And as a reminder, unlike stocks, the starting yield for bonds is a pretty good correlation to what actually results. So not a bad place to be with bonds at around 4 to 5%. With the market doing so well the last few years, the market was up strong in 23, 24, and 25. What is this? Is that normal? Kind of what do we typically see in terms of ups and downs in a year?
Yeah, so strong years can definitely distort expectations. Looking back through history, 1 out of 4 years, you'll expect a negative return there. And the average negative return for a year over year is 14%. So just because you're experiencing a down market halfway through the year doesn't mean that the end of the year is going to end down as well.
Like I like to say, it's the premium you pay for owning stocks is you have to deal with those ups and the down years. Yeah. Moving to the next slide, talk a little about longer term expectations. We had talked earlier about how we don't trust forecasters and why even look at forecasters. But what are some of the quote unquote industry experts think is going to happen over the next 10 years? Folks like BlackRock and JP Morgan and Vanguard and Schwab. What is their outlook for the future returns?
Yeah, with how strong returns have been over the last 10, 15 years, especially in the US market, expected returns going forward are definitely lower. Still expect bonds to underperform stocks, so still getting that premium to actually invest into companies. But again, international markets, we see them a lot more attractive than the U.S. market, and that's what you see across the board as far as the larger asset managers.
So still own stocks or companies and stay diversified. Sounds like a good plan for us. And then to kind of wrap it up a little bit more about it, we've talked about this, those who've watched our quarterly webinar in the past on our 3-step investment process. The key takeaways here is we want to own companies or stocks as much as we can. We prefer to own versus lend to them, and those are bonds. We want to stay as diversified as possible. Our clients own over 10,000 companies globally, and we think that's the best way to find the future winners. And as we saw this last year, that was a great plan, and it worked out well. And then finally, rebalancing. Avoiding those fads and fears, not get too excited about something or too scared, and help put that in place to make sure you avoid the big investment mistake. With that, I want to thank you for joining us today. If you have any questions for Financial Symmetry, you can contact your advisor. If you're not a client, there is a Talk to an Advisor button on the homepage where you can fill that out, and then one of our certified financial planners will be in contact to schedule a meeting. Thank you, and look forward to talking to you next quarter.